And so I'll just hand over to Dylan, and then we can find out all about this fantastic research and sort of the area that they've been investigating. Yeah, so over to Dylan. I'm really interested.
Yeah, thanks, Nick. Yeah, the research was actually kicked off by Margajata Shimyatenka. Sorry, she's in the audience now actually and can help answer some questions.
Oh, that's
Um,
awesome.
yeah, I think I'll hand it over to actually Harry, who will share some slides and some of the research and work we've been doing on how to apply federated learning and how to apply flower specifically to insurance. Over to you, Harry.
Yep, thanks, Dylan, and thanks, Nick. Afternoon, everyone, and thank you for joining us and talk about how our use flower in federated learning for an insurance pricing context. And so this is a presentation on a paper that some colleagues and I have published recently a few months ago. So I'm Harry Lieu. I'm an actuarial consultant and most recently worked on ML risk for a GI pricing model. And my colleagues will introduce themselves later on in this presentation. Move on to the next slide. Okay. Yeah, so what is the difference between an introverted actuary and an extroverted actuary? Right. An extroverted actuary will look at your shoes when talking to you. And okay, let's move on to something a bit more serious. So what is an actuary? So what do we do? So we are experts in quantifying financial risks and finding different ways to mitigate or reduce this risk. We would use mathematical techniques such as probability, statistics, and financial mathematics to quantify future uncertainties. And we generally work in the life and health insurance industry, as well as property and casualty, or otherwise known as general insurance industries, and pensions as well. And the Institute and Faculty of Actuaries is actually the UK professional regulatory body for all the actuaries in the UK. And so we are actually part of a volunteer working party of this actuaries in IFOA, and we do research in many different areas, such as interesting users of machine learning within the insurance space.
Hi everyone. So my name's Scott, and I work as a actuary for 2 years now in the life and health insurance space. So the first thing we're going to talk about is how insurers price risk. So when pricing risk, they typically use current and past data to do this. So they'll group the data into groups based on different risk factors. So for example, I work in life and health insurance. So one factor could be like smoker status, so whether someone smokes or not, and they'll bucket those into different groups. And then within these groups, they'll try and get as many policies as possible, such that they can like pull the risk and reduce the risk for them. So that's kind of where federated learning could come in, because that would allow them to collaborate and get more policies within those buckets of groups. So this might seem quite strange, because why would insurers want to share commercial data? But in part they actually do this already in some industries. So the first application we're going to share here is the CMI. So CMI stands for Continuous Mortality Investigation, and they're like a limited company which is owned by the Institute and Faculty of Actuaries. So what they do is different insurers, like life and health insurers, such as the one I work for, would send them data. So for example, we'll send our like term insurance data to them, and then they'll calculate industry average mortality rates based on all the data from the different insurers. And this is, so that's what these mortality tables are, and they're grouped based on age and duration. So duration just means how far away you are from when the policy was sold. So 0 means it's sold within the first year, and typically mortality is lower for those groups. That's why they do that. And they produce 4 tables: so male non-smoker, male smoker, female non-smoker, and female smoker. So that's what those MN, MS stand for. So they kind of do this because maybe at the higher ages there might be less data for the insurers for the individual insurers to calculate mortality. So that's one reason why they might do this. But then the insurance companies will use these mortality tables and adjust them based on their own experience. So, for example, one insurer might do like lots of thorough underwriting, and therefore their mortality rates might be slightly lower than the industry. So they might apply like an 80% weighting to that mortality table. So I'm keeping it quite simple, but that's one example. And then this will allow them to price more competitively, and then hold less regulatory capital compared to competitors in the market, for example. So I think what this shows is that while this isn't federated learning, that it shows that insurance companies are collaborating already. And it's one application where federated learning could be quite useful, and there's many others as well.
Hello, I'm Michelle. I'm a capital actuary in the general insurance field. And my main responsibility in capital modeling is also to use different statistical methods and calculate the projected capital requirements for the insurance companies under UK Solvency II regulation. And here is another case that we can potentially use the concept of federated learning in reinsurance. So reinsurance, by the definition, acts as the insurers of direct insurers. Reinsurers usually have less data compared to direct insurers because when an event happens, those claims go to the insurance first, as you can see in the table on the left-hand side. So the insurers in the middle layer. And then once those insurers receive claims, then the loss reports go to reinsurers in the final layer. So this table shows that the reinsurers receive information after a few layers and tend to have less data. So the challenge for reinsurance is to achieve appropriate pricing to ensure they don't overprice or underprice. So for example, if they overprice their covers, direct insurers would be less willing to purchase reinsurance. However, if the reinsurance covers are underpriced, reinsurers would face significant loss when a catastrophe event happens. Therefore, reinsurers collect data from different insurers, pull similar risks together, and analyze the loss trends to determine the most possibly appropriate price. And the way of collecting data, training the own model, and updating parameters through different data sources is similar to federated learning. In addition, with federated learning, we could better comply with data privacy GDPR when centralizing data.
Yeah, another application for federated learning would be within the space of Lloyd's of London. So what is Lloyd's of London? So it is actually a marketplace for insurance and reinsurance policies. And many different companies will come together and pull capital together to provide these insurance products. So currently, the different companies will underwrite the same insurance policies using internal data sets, but they can actually benefit from sharing data sets using federated learning, especially if they are writing the same product. For example, some insurance products can have very few data points, such as for space shuttle insurance, where there has been very few claim incidents, and hence, with little data, building pricing model gets harder. Finally, as Lloyd's of London operates globally, they may be able to share data sets across geographical regions using federated learning, while also considering local regulations on such fields.
So in the next section, we're going to talk through the data we use in our federated learning application in the insurance field. So as you can see that we've used the French motor third-party liability datasets, which collect around 700K policies observed over the year for our experiment on the federated learning. This dataset is publicly available. And as you can see in the table 1, there are different fields representing different variables in these tabular datasets, and there are some transformation we've done in our EDA analysis. The final prediction Y is to show how often a driver will file an insurance claim over the year. It's a well-studied dataset, and a lot of actuaries have done the research on this set of data. This data set almost like emanates in convolutional neural networks, as in actuarial data science. So we think using this data set is good for us to perform the benchmark. And the next slide that we are going to show the setup of our model. We've lifted from existing literature with the current model setup. For example, in the data in the table 2, that we've chosen Naden as the optimizer and Tange as the activation function. In the table 3, that this shows how we tuned our hyperparameters to achieve better results, which Scott will give more details in the following sections. And in this slide shows that we've taken the simplest approach, which uniformly and randomly split the data into 10 evenly sized sets to represent there are 10 insurers in our exercise. And the slide of this shows the way of how we encrypt our parameters during training. We've used very simple scheme for the encryption of data. The simple pairwise of masking, as we only have 10 insurers, so that we are less worried if any insurer loses the connection during training. And I'm going to hand over to Scott, which will cover more in this.
Yep, so I'm going to go through now the 3 different scenarios like we ran when we did our project. So the first scenario is the global model scenario. So this is kind of like our benchmark, which we compared our results against. So in this scenario, we're saying that all 10 insurers would have their data shared between each other and sent into like a central data store, as we've got here. So basically, they're all collaborating together and they can all see each other's data. So it's similar to the CMI example I talked about earlier. But in practice, this is less likely to happen. So we're using this as the benchmark to compare against. So the next scenario is the partial model scenario. So this is kind of what most insurers do already. So they'll have their own data and run the model using their own data. So next slide. So now we're going to compare the results which you get between these 2 scenarios. So on the y-axis, we've got the weighted percentage of Poisson deviance explained. So this is a well-used metric in the insurance field to test model performance, and the higher the percentage of Poisson deviance explained, the better the performance. So you can, unsurprisingly, you can see that the global model on the test data has the best performance, with the best performing insurer being at 3.82%, the worst performing insurer being at 2.8%, and then the median being 3.2%. So you can see all 10 insurers are quite a bit worse performance than the global model. So yeah, next slide. And then finally, we've got the federated model scenario. This is when each insurer has got 1/10 of the market, and then they're collaborating, but not sharing data, but using federated learning. So before we talk about the results, which Harry's going to talk about in a bit, I'm just going to go through a little bit about our hyperparameter tuning approach, because it might be slightly different to what's been done before, and I'm just going to explain reasons why. So we use kind of like a greedy algorithm type approach. So step 1 is each insurer runs the following search space you can see below on their local model, which gave local validation losses for each combination of hyperparameters. So you can see we tuned the learning rate, number of neurons in each of the hidden layers, and the batch size doing this. And then once you got the validation loss on each of their own local machines, you can use SMPC to calculate the average validation loss across the 10 insurers. And it's important to note that that you might be thinking, who would do this SMPC, who would be in charge? So the way we envisage federated learning working is that the central body as such would be maybe like a reinsurer or the institute, for example, or it could be a consultancy. So someone that's independent. But it's also important to highlight that they won't see any data. There'll be no data sharing as well. And then finally, you'll choose the hyperparameter with the lowest average validation loss. So this might be slightly suboptimal compared to if you ran the search space through the federated model and tried each combination, but it's also a lot quicker and more likely to be used in practice. So that's kind of why we went for this approach. And then next slide. So yeah, finally, we also had to tune the number of rounds. So the way we did this, it was kind of just more trial and error. So we went up in, so I think it was like, I can't remember now, it was like 20s or 30s until we seen overfitting occur. So you can see here in the graph that once you reach about 300 rounds, you start to get overfitting. So that's why we chose 300 rounds as our number. And then finally, the local epochs, we kind of tried a couple, but we didn't really concentrate on this as much, and we found that 10 worked quite well. So maybe if we had more time, that's something we could have considered to look into a bit more. But I think, yeah, for our experiment, we just chose 10 local epochs.
Yep. And moving on to the comparison results. So this slide shows the results for all the global model, the federated model, as well as the individual insurers. So here we can see that the federated model achieves a weighted PDE of 5.34%. And this is actually quite close to the global model's accuracy of 5.57%. However, it's important to note that in actual implementation, there will not be a global metric to compare how well the federated model has performed, because you just don't have that data set in the first place. And it also shows that actually the federated model achieves a far better performance compared to all the other insurers would have if they have just used their own data set to build the models. So this is definitely a good result for federated learning in insurance. And I guess diving a little bit deeper into our results. So here we have a double lift chart, and this plots actuals versus expected. And so along the y-axis, we have actuals against expected, and we have the orange line, which is which shows the actuals for the expected, for the global model. The green line is also the expected for the federated learning model, and the blue line is the actual frequency. And for the x-axis, we have different risks. The risks that are ordered from left to right in even buckets, from lower risk to higher risk. And so on the left side of the graph, if we look at the orange line for the global model, we can see that this is actually over-predicting by about 25%. And for the federated model, given by the green line, is under-predicting by about 30%. And moving across to the right side, we can also see that this sort of gives an edge shape in the predictions for the global and the federated model, which shows that there is no obvious winner because there's some over prediction going on and some under predicting. But if we move on to this slide, which shows the actual predictions of Nishar number 5 against the federated model, it is far better graph that shows how federated model would work very well for engine number 5. So again, on the left side of the graph, you see the predictions for engine number 5, which is about 125% over the actuals. And moving on to the right side, you're probably about 30% under the actuals. So whereas the federated model is a lot closer to the actual, so this HR definitely gain a lot from using a federated model. And so I guess moving on to what's the drawbacks. And so on the graph on the left, we have a graph of how, I guess, the time it takes to train our federated model. So note that the graph is shown in units of training time. And so what we've done here is we've compared the time taken to train the federated model against the average time taken to train each of the 10 local models, as well as the global model. Expected the partial models have taken about 10% of the time to train compared to the global model, as you're effectively splitting the global data set into 10 chunks. and training those technical models in parallel. However, for the federated model, it takes about 2.5 times longer to train than the global model. But note that this is not a like-for-like comparison because the federated model is trained for 300 rounds on 10 local epochs, so that is essentially 3,000 parameter update steps, whereas both the global and local models use about 10 times fewer updates using just 300 epochs. And finally, moving on to the graph on the right, this shows the model accuracy improvement as we would increase the training rounds. So we can see that the global model does not show much improvement after about 250 updates. However, the federated model is still benefiting from over an increase of improvement after over 3,500 rounds. So I think this is definitely where we might be able to push the federated model a bit further. And yep, we have come to the end of our presentation, and I guess we'll move on to the Q&A session. So I'll hand back to Ellen and Nick.
Great. Well, thanks so much. It's really interesting work. I think some of the best examples of federated learning I've seen in the insurance field. Really, there's a lot of discussion, but not always a lot of systematic analysis and comparing. So it's really great to see. So I should also mention that we are also joined for the Q&A by I'm sorry, I'm going to try to pronounce your name correctly, but Malagozata.
Yes.
Maybe if you want to tell us.
Correct, Małgorzata.
Małgorzata. That's radically different to what I said, but she was the lead author from UCL on this work, so it's very appropriate. So she's here, and so if anyone here wants to ask some questions, we can open the floor. I'll look at Slack, but also given the group of people we have, I sort of asked some broader questions too. But let me I'll open Slack up here to see if any questions roll in. But while we're waiting for a few things to come along, maybe I could just ask could maybe Dylan or someone explain what is the Federated Learning Working Party trying to achieve? Are there a number of working parties in this organization working on different sort of new dimensions to explore, or I haven't seen it before?
So we're part of the Institute and Faculty of Actuaries. Like, Harry and the guys explained, this kind of a professional regulatory body, like, with accountants, you've got people who dish out their qualifications, you've got, the Bar Association for lawyers. But Małgorzata, myself, the rest of the guys, our day jobs are like actuary. We work in insurance companies and we get regulated by the IFOA. And we do this research in our spare time on the weekends for fun, because we love it. We don't get paid to do it. And it's just kind of like a piece of pro bono volunteer work that we do. I guess we're just really hoping that insurers can start to use federated learning. Many actuaries do this kind of pro bono spare time research on the weekends in different areas. Data science, AI is a big growing thing, obviously. So there's a lot of working parties. We've got one set up specifically to look at Gen AI and LLMs and that kind of thing. But for federated learning, I think we're the only ones that are looking at federated learning within the IFOA. Now, in other countries, what I've seen is there's actually in America a group called the Society of Actuaries, which is kind of like the American counterpart. They've also done some research into federated learning in insurance. Their research was a little bit different to ours. I think they used a more kind of synthetic data set, whereas the data set we used was on a real set of car insurance claims. And we tried to, I guess, make it quite realistic and say, here's how we think it would look like for an insurer. What they did, I think that was a bit better than us, though, is that they did both horizontal and vertical federated learning. Whereas, you can see in our work, we really only considered insurers sharing like rows rather than columns of data.
Sure. Yeah, makes sense. Was that data set, I didn't quite pick up if that data set was publicly available. It is. So researchers on this call or out there could experiment with it too.
Yeah, that's what Michelle was explaining. I think for actuaries, if you work in insurance, this is really like the Titanic data set of our work. Like it's just an open public data set. Like loads of papers have been written on, loads of academics have benchmarked it, so you can get a good sense of, is my model in the right ballpark or not?
I
So
see.
why Michelle said it's almost like MNIST, but for actuarial
Yep.
science.
Oh, that's great. Yeah, because in some fields you have to be, in a certain profession or have some sort of qualifications, accreditations to get access to the data. But it's great that it's quite public, so even computer scientists can play with it.
Yes, it's on OpenML, if you guys know that. Or if you read our paper, we've got a link to that data set if anyone wants to try and replicate it.
Great. I mean, one of the other questions I was going to ask you all was, what are the different avenues you could imagine federated learning being applied? But I noticed in the talk you had your three very concrete ones, which was great to see. But I mean, I guess within this topic, perhaps I don't know if anyone wants to kind of describe maybe something that they think could be an interesting next step, but that wasn't listed, or maybe their favorite one, or the one that they think could really shift the needle beyond the three that were described. Or so again, this is about applications of federated learning within the insurance field broadly.
Yeah, I can have a start on that. So I think one thing we sort of considered is the different. You're talking about the two different types of federated learning, horizontal and vertical. So I think we concentrated more on horizontal federated learning, and a lot of the applications we discussed were about horizontal federated learning. So it's where you can put the data together to pull the risk and reduce the risk that way. But I think another thing obviously is the vertical federated learning, where that could be useful maybe when in health insurance, for example, if you want to use wearable devices with health insurance, and that's where you're getting extra information. So then that would be more applicable to vertical federated learning, for example. Whereas maybe the pulling of risk type of stuff is probably more suited to horizontal federated learning.
Right, because I guess in the scenario you gave, for example, it was all about trying to get access to more data. And so then each institution, each insurer did have data, and so they're relatively the same sort of data, but you just want to pull it together in a safe way.
I think it might depend on where you work. So in what we might call personal lines insurance, like a health insurer that I work in, we often do have quite a lot of data, so there's not really a struggle that we have. But Scott's example in life insurance, there's not many people who get life insurance who are very, very, very old. So that's why you kind of have the CMI doing this kind of almost pseudo federated learning. I can imagine Harry's example in the Lloyd's of London market, where you're insuring rocket ships and you have next to no data, and you're really going to struggle. But because, like Michelle said, a lot of people reinsure each other. So this kind of chain of insurers, they all have a similar vested interest and a similar skin in the game, but they don't really or not readily exchange data with each other. I think so. Even within an insurer, vertical, federated learning, sharing columns sharing features could be worth pursuing, because sometimes I find that even within a company, you're not always allowed to share data between departments. I used to work for a bank insurer before, and although you might have a customer who has both a bank account and an insurance policy, believe it or not, sometimes you can't actually connect the dots between them. But often companies do like to have a complete view of a customer, or do some kind of lifetime value modeling, of what customer might buy several products from several of your subsidies within a big multinational conglomerate, but they don't actually always share the data. So I think federated learning, even within a company, or maybe different sites you have around the world, you could use federated learning for.
Yeah, so within
Another
company,
very, very interesting one that I can think of is vertical one. When, for example, healthcare providers kind of enrich insurers' database with the health records, kind of helping to create price products for which we have not enough data. For example, heart attacks tied to diabetes. So this kind of multi-sector collaboration may be possible with federated learning.
That's really interesting. I can see that. Really changing how the industry functions. So I guess that brings to a question of so what are the challenges that you foresee that would stop work like this going from research and exploration to actual practice? For example, I know in finance there's always a bit of uncertainty about policy and regulation and clarity on that, because this tech is a bit different and wasn't always in mind when they wrote these regulations and compliance laws and so on. But yeah, I'm curious, what do you think the main bottlenecks are here?
Yeah, I think it's exactly that, Nick. So we've had some talks with some people who are trying it out, a bit more adventurous, and I've had a few talks with my insurance peers, and some very highly regulated industry. Insurance has many rules, many compliance issues. We really want to protect our customers in the insurance industry. No one wants to go bust. And it's new tech, like you said. I think the regulation isn't super clear. And I've talked to a lot of privacy and compliance professionals. If I mention Federated Learning, I can get some pretty bewildered looks. Pets in general, it's pretty cutting edge stuff. I don't think the regulation has moved quite fast enough. So if you work in a really highly regulated industry, you've got to be willing to be quite bold and take a big risk if you want to try and employ this for real in a kind of financial institution where there are some seriously hefty fines and ramifications if you breach any kind of data regulation or compliance issue. So I think getting regulators over the line, getting your internal compliance is probably going to be the big hurdle. Legally, where it lies as well. I'm not a legal expert, so I'm not sure what the rules are on Federated. I don't know. Does anyone else know what exactly you say?
Actually, my recent research I discovered that it's changing, because there are currently some policies, upcoming policies, like the open finance policies, that actually encourage the secure sharing of financial data, including insurance data. So I think it will change towards sharing data and making them available securely. So federated learning and other privacy enhancing technologies might play a crucial role here.
Interesting. Yes, I didn't expect that the main reason was going to be on this policy, compliance, clarity on regulation side of things.
But, to add to that, I think it's also because of lack of knowledge about federated learning, lack of trust to that technology, so that's why we are here as well, and we try to promote federated learning and privacy enhancing technologies to insurance industry and promote our research and application.
Excellent. I see. Cool. I guess on the other side of things, I was also curious about what are the key factors within the industry that would determine the success of deploying federated learning collaborations between insurance companies. So, what would be those key factors that would make it successful collaboration between insurance companies? I know, for example, in the automotive industry, there's issues to do, and drug discovery, there are issues to do with data sharing is really good in terms of improving the quality of some of the products, but there's also quite a lot of concern about sharing certain types of data because it can indicate certain competitive kind of sensitive information, not just about the people involved, like the consumers, but about the nature of the businesses that are collaborating. Happens in drug companies and car manufacturers I've seen as two the examples that come to mind. So I don't know if that protecting that is important, or maybe there's some other types of success criteria.
I think protecting the data is going to be real number one. Insurance data can also be quite sensitive. Again, I work in health insurance, so the kind of data we deal with is essentially medical records and what kind of conditions you have. So yeah, I think first and foremost, people would really need to be confident and can rest assured that if you do something like SMPC and you're only sharing encrypted gradient weights, that actually means your customer information is really actually protected. And other than that, commercial insurers would want to see some, pretty decent commercial upside. The kind of things that they look at for, would be, are they holding on to customers? Is it leading to more growth? Is it leading to more revenue? Is it leading to a more optimized kind of portfolio, but without, compromising any data whatsoever?
Right. So I suppose they want to imagine. Oh, sorry. Yes.
Sorry, I think those clear incentives, would make a change if there is a way to kind of monetize the data in a secure way. That would be a game changer as well. So how to collaborate at the same time being competitors, that's difficult, but it's possible, especially in a fraud detection where they don't compete. Different insurance companies don't compete. They all want to have better fraud detection models. So it's about finding the right use case, or being in a way forced by regulation to secure the data even more when making them accessible according to the open finance regulation, or when wanting to monetize them or collaborate.
I see. Makes sense. Well, we're actually running a little bit low on time, so I better move on. But I just before we move on to the next session, any parting thoughts about insurance and federated learning? Anything exciting that you've seen, or anything kind of like you hold dear in terms of views?
Well, I think we're kind of the pioneers, as far as I'm aware, in insurance and federated learning. We're trying as hard as we can to push it, but I would say that parting thoughts are that probably it's not such an alien concept to insurance. Like Scott was saying, I think insurers have been doing some form of federated learning for many, many, many years. It just hasn't been using Flower, and it hasn't been as efficient because we've been sort of centralizing and pooling data. I mean, one of the most fundamental things about how actuarial science and insurance work is essentially the central limit theorem. It's a sufficiently large N with, IID risks, things tend to get more normally distributed. So insurers love to get data. They love to pull it together. That's kind of the bedrock of insurance. It's all about like a volume kind of game. And I think federated learning is probably, the next big secret to unlocking loads of value in insurance.
Wow. Yeah. Cool. I mean, it's great to see an industry that seems to be on the same wavelength as the technology. So that's cool. Well, thank you all for joining us today. I feel super lucky, very lucky to have all these experts here talking about federated learning insurance who know both sides of the equation. So yeah, thank you all for joining us.
Thanks, Nick. Cheers.